Welcome. We're going to thank you for joining us today. We'll wait for you to fully participate in the webinar. We'll give it a few minutes and enjoy the photo. This is an image from Development Impact Bond, Educate Girls, and UBS Optimus Foundation. It's a photograph taken by professional photographer Mark Tushman, who's in Silicon Valley, and he did a series of images for the Educate Girls Development Impact Bond, first in the world, and it's magnificent. So we actually, for our social finance course, Phyllis Costanza, who's the CEO of UBS Optimus, UBS and Society, is going to be talking with us about development impact bonds in health, education, and water access. So thank you all for joining us. And we are excited to have you with us. I'm program director of 2 out of our 4 impact programs, social finance and impact investing. And the webinar series allows us to go deep into topics. In this case, we're focusing on social finance and ask our experts who are joining us today. And I want to help you understand what you'll take away from a social finance perspective and how we perceive social finance. So we begin with just some beautiful places in Oxford. And I do this because I have been away from Oxford because of COVID for almost a year and a half. And so it's always wonderful to see images of Oxford. And I will be back in Oxford in September, with COVID willing. So the goals of our impact portfolio are really to show how capital can tackle the world's most complex problems. We call them wicked problems. Those problems that don't have a solution. We can make progress against those issues, but they're interrelated and complex. We share groundbreaking ideas across the portfolio with thought leaders, and we build and strengthen a global network. And we've taught students from probably 700 students from 90 countries. Our social finance goals are really about catalyzing capital across the impact finance ecosystem. And we learn together on how best to negotiate partnerships and measure impact. This is Said Business School. Again, you're giving me the joy of seeing the business school again. It's a world-class community designed to tackle complex problems and to bring together those innovators and to test new ideas and to have a global impact. And that's the intention of the school, and that's how we move forward. Again, when we think about the impact portfolio, and there needs to be another circle on our impact finance innovations, but impact investing, social finance, impact measurement, really we begin to think of it as a suite of interrelated programs. We think about what's different about impact investing and social finance. And we really, for impact investing, have a sliver of this ecosystem. And we begin with philanthropy and move all the way across the spectrum. We're deploying capital from catalytic philanthropy. We focus on impact investing as a portion of it, and we move into development finance and ESG. So it's really across the spectrum, and that's what makes this program unique. Impact investing is very tight constraints. Social finance carries you across the ecosystem and how to deploy that capital. And that's the importance of how we use and distinguish between the different programs. This is a simplified version of that. Finance, traditional business, social enterprise, but it's across that spectrum. And I think that's what makes social finance unique and important. The other piece that's distinguishing about our social finance is we have a CEO leadership circle. Only CEOs teach on this program. And we do that because we believe that CEOs will speak the truth about the challenges they face. When you're dealing with the world's complex issues, things will go wrong and things will go right. But we find that CEOs are always honest and candid about what the challenges they face. And we want you as leaders in this field to really understand that. We're looking at creating systems change, looking at economic alternatives, using creative capital to do that. We do a deep dive in environmental ESG, environmental social governance investment. We focus on negotiation and building and sustaining partnerships across a blended finance approach. Impact measurement and management is essential. This year, we're going to focus on climate and conservation finance, development impact bonds, again, in health, education, and water access, deploying capital to end poverty, creating sustainable livelihoods, ending slavery in the supply chains are illustrations of the kinds of topics that students will tackle. And we'll have an experiential learning process where teams will pull together over a 6-week period to come up with solutions to a real life challenge, working with real life, real-time investors. So experiential learning, we're finding, is absolutely essential in a virtual world, and the results of those experiences are transformative. We think about this again, the ecosystem from early, seed, mid-level, and late, and deploying capital in this context, the role of investor, the role of development, the source of funding, the type of investor type. This is the social finance arena, working across the spectrum. And again, with a focus of people and planet at the center, using SDG as a centerpiece. Unraveling the wicked is what this course is about, deploying capital to do that. Again, the Sustainable Development Goals are an anchor for us. Today, we're going to be hearing from Jenn Pryce, a colleague who's been a faculty member both in social finance and impact investing, and she'll share her experiences. But also, Joan, welcome. This is your first time with us. Joan is the CEO of Convergence, the guru in blended capital and blended finance, which is really exciting. We're going to hear from Joan first and talk about her experiences and what Convergence does and what the opportunities are in the context of blended finance. And then Jen's going to go next to really give us some illustrations of how she has used blended finance in her deal making. So good conversation, good discussion. We're going to open up to questions and listen to you. That's the centerpiece of what we learn. And then we'll talk about how you can learn more about social finance. So I'm going to stop sharing. Joan, you're going to share. Fantastic.
Thank you. Okay, if I've done this right, you can both see my slides and hear me. Wow.
Yes.
Not bad for the end of a long weekend. Hello, everybody. Good afternoon or good morning, whichever it may be to you. This is Joan Larea, and I'm thrilled to be here with Gayle and Jenn. I'm going to describe to you very briefly what Convergence is, just so you know who's talking at you. Then I'm going to describe for you what blended finance is and where it's happening and who's doing it. I have two short examples of it, and then I will pass, I believe, to Jenn, who is actually in the market doing transactions. So I'm going to be really looking forward to teeing her up properly. Just to get started, if I may, what is Convergence? We are a not-for-profit corporation based in Toronto, Ontario, Canada. And we operate as an ecosystem builder. We don't do transactions. We don't manage people's money. We operate on a membership model and try to help everybody who's trying to wrestle with wicked problems in finance, try to use blended finance where it's appropriate. So we are a global network. We provide data and intelligence, and you're going to see some of the statistics I'm about to share with you. You can also go onto our website, which is www.convergence.finance, and see full-fledged case studies. They're 8 pages long. There's a lot of other resources from us, from other people, and we do training. The other thing we do is try to help more transactions happen by, for example, allowing them to be posted on our site if they match our specifications. And we do have some modest grant resources at our disposal that we use to try to support teams who are bringing ideas to the market who otherwise would not get those ideas into the market. So that's us. And just a quick snapshot of our membership. It's a couple hundred member institutions. And if you think about the slide Gayle just showed you about the capital spectrum, it's all represented here. We have got fully donor-based entities like USAID, and on the other end of the spectrum, we've got Credit Suisse and others who operate totally with commercial principles and investment principles in mind. So we have a unique membership that tells us all the different angles of what's happening in blended finance. I'm glad Gayle put up the SDG chart because I wasn't sure if everybody was going to know what the SDGs were. So that's answered. Again, a brief reminder of the challenges to finance the SDGs before 2030 and how that seemingly enormous challenge compares against the supply of actual commercial money out there. The answer is it's a large challenge in the developing markets where convergence works and Jenn works as well. The financing gap, the annual financing gap is somewhere, they keep saying, in the realm of 2.5 trillion. I suspect it's more because we're falling behind and we only have 9 years left. Official development aid, the kind of money that UK DFID, now FCDO, or USAID put out, it's been around $150 billion year after year, and it's not accelerating. There's no more of it. So it is not enough to get everything done. And then if you look at the other side of the house and you look at the private markets, the SDG funding gap as a percentage of global GDP, as a percentage of annual savings, as a percentage of the money sloshing around the capital markets on any given day is very small. So how do you get that money, some of it, a tiny fraction of it, aimed at the Sustainable Development Goals? Blended finance is one method to do that. And it's simply a structuring device. It doesn't work everywhere. You have to have a revenue line. Somebody has to make a profit, but it is a good structuring device in some circumstances. Very briefly, what is blended finance? It is simply the deployment of development funding, which can be from philanthropic houses or from donor agencies that are government agencies, put into a financial structure specifically for the purpose of getting private sector money that's operating on commercial principles to take a step in where it otherwise wouldn't go. Conceptually, what is that doing? If you think about the efficient horizon, the market horizon where investment happens, that is where risks and rewards are calibrated, there is a curve. And the more risk you ask an investor to take, the more expected return they're going to ask for. And that's the blue line on this chart. There are a lot of transactions out there that actually do make money, but the risk profile is too high. And that's the notional .A on this graph, where the expected risk is pushing the transaction too far to the right of the efficient blue line where money wants to play. So blended finance is the application of concessional or catalytic money to either push that .A to the left, that is to reduce the risk and get it onto the blue line, or push that .A northward, upward, that is to juice the return of a transaction from the private sector participant's point of view, so that now for the given risk, there's more money on the table. So the goal of blended finance is to try to calibrate risk and reward so that you trigger an investment that otherwise wouldn't happen. So you can either go from A to B or A to C. The market is indifferent. A lot of donors are very skeptical of going from A to C, but mathematically, it really is the same. There is money out there that will respond to either going from A to B or A to C. Key characteristics of what Convergence thinks a blended finance transaction should have. It should have commercial capital that's leveraged by concessional capital. That is, it wouldn't have happened otherwise. It ought to have some impact toward the SDGs, and it has to have some kind of return. There are many ways to blend. I think in the interest of time, I'll skip this, but I've just listed some examples of blending on the project level, blending fund level. You can blend once at the fund of funds level, or you can have a facility, a permanent facility that is blending capital. If you go onto our website, there is a Blended Finance 101 page that gives you an awful lot of statistics on what the market looks like. So I will just touch briefly here. We know at Convergence, we have collected data points on transactions happening in the market for the past 10 years. We keep collecting this data. It's the largest store of data there is on the subject. We know of about $144 billion. See, it's billion, it's not trillion, it's not where it needs to be. We know of about $144 billion worth of business over the past decade or so that's happened, that's used blended finance that we've verified. And there have been over 1,000 participants and, about 500 transactions a year that we have been able to clock as we've looked at the market. We looked at the deal count. This is not financial value, this is deal count. And we noticed that sub-Saharan Africa is a very frequent destination for blended finance, followed by Asia and Latin America. It makes sense. The donors are there. Those investors who are looking for, uncorrelated returns are also there. It also happens more frequently in middle-income countries, specifically lower middle-income countries, than the very least developed countries. Frankly, investment doesn't happen that often in the least developed countries. So blended finance, too, is very tough to pull off in the least developed countries. Not impossible. We do see data there. What sorts of activities is blended finance targeting? Very often energy. It's usually renewable energy, infrastructure, financial services. Those are sectors that are almost investable, even in places that are tough, and therefore some blending will get you over the line pretty often. Who's doing this stuff? This is a list according to flavor of capital. So on the truly donor-minded side of the house, you see USAID and others stepping up very frequently in blended finance. This is number of transactions counted. Development banks, we see IFC and FMO a lot. IFC is typically investing on commercial principles, although they will do things that straight up commercial investors won't do, like 20-year loans. But they also have access to grant resources, and they also collaborate in transactions where somebody else is providing the concessional capital. Philanthropic investors, you see the Gates Foundation, Midjar, Shell, Dune out of the Netherlands. And on the private sector side of the house, you have everybody from impact investors to very commercial-minded houses, from Standard Chartered, Deutsche Bank, Societe Generale, JP Morgan, and so forth. I'm going to give you a quick tour of what these structures look like. And I won't spend too much time on any of these, but just to give you a sense. So in a transaction that's blended, on the left side of this slide, you may see a capital structure where there is concessional money inserted as some kind of not quite commercially structured debt or equity that is taking a first loss position. You may also see blending where the structure itself is somewhat normal, but there's a guarantee being applied to shave off some risk, and that guarantee is not fully priced. That's concessional. The third structure on this slide is where the grant money precedes the other money. It's like time-lapse photography. You have a grantor step forward and say, but for me taking a whack at this, it's not going to happen at all. And I'm going to until this thing looks like it will support commercial capital. So that's grants coming in before everybody else. Three more flavors of blending. We see technical assistance funds. So you may see a fully commercial structure and next to it, a pool of grant money that somebody is able to dip into to strengthen financial institutions, to help female borrowers, to reach further into an agricultural community, to do something that's not commercial, but will help the risk profile, both of the investment and of the local financial ecosystem. Another flavor of blending is where some granting agency or something like it steps forward and says, this project would work if the capital costs weren't so high. I'm just going to, pay for the land site on which the water treatment plant is going to be built, and that allows somebody to bid a lower tariff. Or I am going to provide a subsidy to the revenue line. And finally, you have results-based financing, like the Educate Girls Impact Bond that Gayle mentioned going in, where a donor is paying for outputs, not supporting the financial structure itself. Two quick examples, if I may, and these are not things that Convergence has done. These are just examples we have seen out there. So I am not tooting our horn, nor am I proposing that any of you run out and invest in any of these things. I'm just giving you examples of things. I'm going to show you two examples. One is a bond structure and one is a fund structure. So the bond structure was Acorn Holdings in Kenya. They wanted to build green student housing and they wanted to float a bond. So what they did was they went to an agency called Garantco, which is part of a suite of institutions that were set up by donors to support, in most cases, local currency financing. So Acorn Holdings wanted to float a Kenyan shillings green bond because it's green student housing. And they wanted to get it to be rated. And there was no way to do that without some kind of credit enhancement. So Garantco, which is again, it's a concessional player in the market, provided a partial credit guarantee for half of the principal and interest to bondholders. That pushed this structure up to a Moody's B1, and it floated over a 40 million US dollar equivalent bond. It was listed dually in Nairobi and London, and it is, I think, the first green bond in Kenya. So it's a nice example of blending, getting you into a class of different investors. The benefit here to the world partly is that the cost of capital is lower, and so the overall cost of this project to put housing out there for students was lower than it would have been if they'd done a private transaction. My other example that I brought with me is Climate Investor One, which is a fund structure. So if you look at the right hand of the slide, let me just back up a second. What they're trying to do is build renewable energy projects in emerging markets, including in Asia and Africa. The problem with building renewable power plants or any power plants is often that they're very high risk to find the site and to figure out the regulatory environment. They're quite high risk to build because things don't always work perfectly in an emerging environment. And when you start to sell your power, your plant can't be up and moved. It's there for 30 years, and the utility may or may not have the capacity and willingness to pay. So building power plants in developing countries is often quite thorny. So what Climate Investor One did was to say, look, these are three different phases of risk: the prospecting risk, the construction risk, and the risk of something once it's up and running. So why don't we put three funds together with different mixes, different blends of capital? And that's what they went and did. So on the right of this page, you've got a dark gray square, which is a development fund, totally grant funded. What it does is go around and look for sites, negotiate with local authorities, figure out the regulatory system, get the permitting. This is often high failure rate activity. And in the countries we're talking about this fund targeting, nobody wants to take that bet with money that might need to be paid back. So the development fund operates with pure grant capital. And once it gets a project to the point of being buildable, a construction equity fund run by the same folks steps in, almost buys the project over and begins an equity-only construction process that hopefully speeds things up by being able to fully fund a project. Once they turn the lights on, start to sell power, you have a radically different risk profile asset, and that asset can be flipped to a third fund, which is totally commercial. So you have a different type of blending over the course of a project. So this fund will go out and do deal after deal after deal and throwing each asset from one box into the other as it gets built and comes on stream. This transaction has already raised $850 million. So I think it's a good example of the ability to get to scale with some smart structuring and some blending. So I hope those two examples for you were useful to take you from sort of conceptual down to the real. And I will pass the baton back to Gayle, and I will stop sharing my screen if I can figure out how to do that. Hold on just a second. I'm not that adept at this stuff.
No, that's great, Jenn. Don't worry about it. It should be at the top. It says stop sharing. And what we'll do is we'll hold on to questions for after Jenn's presentation, and we'll have a conversation. And yes, these slides will be available and the recordings will be available. So not to worry about that. Jenn, thank you. You're on.
All right, and you can see the slides, right? All right, then I'm on and I'm rolling. Thank you, Joan and Gayle, for laying the foundation. I'm going to go a bit deeper into deals and transactions. I'm a practitioner. I am the CEO of Calvert Impact Capital, and we're based in Washington, D.C., but we lend, we invest in over 100 countries and across all impact sectors. So we see a lot. And quite frankly, I think right now we have 110 transactions in our portfolio, about 600 million in size, and every one of them has some element of blended finance. And that's because, as Joan indicated, we do transactions that traditional markets don't. There's something about that transaction that doesn't pencil out. And so what we're often doing is bringing private capital, but we're also helping the parties around the table come together. One of the things that makes blended capital painful, but also very rewarding, is the multi-stakeholder and negotiating. Some of the topics that Gayle indicated, we really dive into in the course, and that's bringing a lot of different parties to the table and bringing them together in a way that everyone's getting out what works for them and their own goals, but more importantly for the community. And so two of the transactions I want to share with you today are two that you might not at first blush think that there was blended finance involved, but there is. And the first is we were investors in it, and it was the world's first ever blue bond. This was a issuance, a sovereign bond that the Republic of the Seychelles issued for $15 million. I think it was 2018, if I'm not mistaken. I'm losing track of time. But it was a 10-year bond that they issued, and there was 3 institutional investors, Calvert Impact Capital being one of them, that came in on the deal. And what I wanted to just share with you is where the blended finance showed up in this transaction. And what we were trying to achieve through this transaction are the 4 bullets you see below, which is the impact: protecting marine area, developing a sustainable blue economy, and creating high-value jobs and ensuring food security. Those were all impact goals of this transaction. And I'm just trying to get my page to go. It's not going for me. There we go. And just to step back and just really reinforce this point, this is the Seychelles. And I had the pleasure of being able to visit and do a site visit as we were underwriting and due diligencing this transaction. And again, just to emphasize what both Joan and Gayle shared is, with blended finance, yes, we're trying to attract private capital. Yes, we're trying to get scale, but importantly, we're ensuring that the capital meets the needs of the community. And that has to be really considered as you go walk down this path. And that's what you'll see come through in this transaction. So these next 3 slides, I'm going to dive deeper into the transaction, and then we'll lift back up at the end. But you'll see where the blending happened, where that blending was vital so that the impact outcomes could really come through in this deal. So on this slide, I'd like you to focus on the bottom left corner where it says blue bond in a blue box, and then there's 2 boxes to the left of it. The Global Environment Fund is the acronym for GEF, and the International Recovery and Development Bank, I might have said that backwards, but it's the IBRD. I always just say the acronym, is the other catalytic capital provider. So there was 2 catalytic capital providers in this transaction. And to go back to Joan's slide, and you'll see this in the next slides, the top CEF was there to reduce the cost of the coupon, of the interest that the Seychelles had to pay. And the IBRD was there to reduce the risk to the investors so that they would get repaid. So we had 2 catalytic capital providers. Also on this graph, I just want to show you is the 2 boxes at the top, the GEF grant in green and the IBRD loan in red. Those 2 preceded the finance transaction. And this again goes back to Joan's different transaction archetypes. There was enormous amount of money put in just to set up the right ecosystem so it could be financeable. A lot of this was done through the World Bank's leadership as Seychelles was part of a larger program called their Swafish program. And all of this was very aligned with the government's own goals. And the last thing I just wanted to show is what you see component 1, 2, 3, 4. Those are the impact outcomes. And specifically for the blue bond, what we were trying to achieve was increased marine conservation and also loans to help fund sustainable businesses. So digging deeper into the blue bond and just to illuminate those two levels of credit enhancement and how they enabled private capital to come along. So the risk reduction I mentioned, the IBRD, it was a $15 million transaction, and the IBRD had a guarantee of $5 million in this deal. So what that did was reduce the risk to us, the investors, that if everything went sideways and the Seychelles wasn't able to repay us, $5 million would be paid by the IBRD. So each of us would, and we each only were $5 million invested, would have a third of our capital protected. The second bullet, the DEF, what they were doing was they were actually providing a grant to the government of the Seychelles. The government of the Seychelles would use that money to pay some of the coupon that was owed to us, the investors. And why was that important? For the impact to happen that I mentioned on that slide before, protecting marine areas, creating loans, which needed to be low interest rates to sustainable businesses on the Seychelles, in the Seychelles, they needed very low rate capital. The challenge was the Seychelles is a BB minus, I believe at this time, double B minus investment grade issuer. The risk return without these two supports you see here would have been closer between 8 and 10% that we as investors would have asked for to be properly risk return adjusted on our return for this investment. And that capital would have been too expensive for the Seychelles to achieve that impact they were seeking. And so with both of these blending mechanisms, and you can see this in the green box down below, the Seychelles ended up paying effectively 2.8%. And so there you have a lot of the elements that Joan laid out, and one of it, how it comes into the real transaction and really succeeding in this case to uphold the fiduciary to impact, but also get enough capital into the transaction, 15 million, to really do some of the work that was needed, and also to demonstrate this was the world's first blue bond. And so to have it out there as a template to then iterate and expand on was really exciting and really groundbreaking. So one example. The second one I wanted to share with you quickly is in the US. And so, Joan, I think Convergence focuses on emerging markets, but blended finance you can find in all markets. And there's a lot of examples of blended finance helping spur development in developed markets. And this is just an example of the opportunity. This is a quote from the FT in February of this year, 2021, written by Gillian Tett. And I love this quote here. I just got to move this off so I can see it and read it to you. But in the US, the whole article is advocating for blended finance to be a strategy to retool the energy infrastructure. And this quote, the idea is to encourage mainstream private investors to finance projects they would otherwise shun because the risks were unmeasurable, long-term, or too idiosyncratic to hedge. And that's it in a nutshell. So in the US, it wasn't around energy I'm going to share with you, but around small business. This is a transaction that we are, and will be intimately involved in for quite some time. We got into this because right when COVID hit in the US around spring of 2020, when the economy closed, the economic fallout was severe, but particularly severe for those that were the smallest of the small businesses. if you're familiar with the US, or maybe you heard, what happened at that time is the government put in place a program where they provided loans to businesses to support the costs that they had that they weren't able to cover because there was no revenue coming in. How they got that money out to businesses, however, was through very traditional infrastructure, meaning banks, large commercial banks. And so if you had an existing banking relationship, you were in good shape. You could go down to Bank of America or JP Morgan, apply for a loan, and hopefully get one. However, if you were one of the smaller businesses, likely less than 20 full-time employees, maybe you were based in a rural area, or you were a business led by a woman or a person of color, you likely did not have a banking relationship and there was no way to access capital. And what we saw sitting where we did at Calvert Impact Capital was that we were in a really precarious position. We were at the edge of wiping out a whole community, a whole swath of businesses in community if we didn't find a way to get capital to them. And so with partners, I mean, many partners, government, philanthropic, corporate, took a village. We began a process of getting capital to these small businesses. And one of the big lessons, I learned through this is that structure follows strategy. And so Joan shared a lot of structures. The structure follows your strategy. And you'll see what I mean here. Our strategy was to get capital to those smallest businesses and quickly, because they didn't have time to wait for 7, 8, 10 months for us to get a deal together to get capital to them. They needed it tomorrow. And so what we looked at was leveraging the infrastructure in place. And so you'll see on the right, originating CDFIs. This is what I mean by leveraging the infrastructure in place. In the United States, there's a group of organizations, they're called Community Development Financial Institutions. They're unregulated banks, there's over 1,000 of them. And they were founded in the 70s and 80s. They became a certified entity infrastructure by the Treasury, the US Treasury, in the early 90s. And what they do is provide capital where traditional capital doesn't go, to rural communities, to communities that have low wealth, businesses run by people of color and women that often are biased in the distribution of capital and don't receive it in the same volume or size. And so these CDFIs are all over the country. The challenge at this moment in time, they were serving this population, but they couldn't serve the population at the volume that they needed to. The demand was huge, and they only had a limited capacity, a limited amount of capital to put out. And so we came together and we created the blended finance structure you see in that pink or orange, red, I don't know what color box. And what we did is across 18 states, this is the one in the South, we created these separate vehicles. They were SPVs, special purpose vehicles that we stood up, and their purpose was to buy loans off those CDFI balance sheets. So they would buy 95% of each loan, and that would free up capital and balance sheet capacity for that CDFI to do more lending in community. And you can see all the different institutions that came together to make that vehicle work. We had banks and other institutions in the senior position, and you'll see then the subordinate capital below. We needed the subordinate capital because we had a lot of banks and the other institutions were corporates, really eager to be part of a solution for the small business community. And because of a lot of, in particular, technology corporations sitting on a lot of cash, they were willing to invest from their treasury. But they were very risk averse to losing any capital. So they were open to taking very low interest return, but very risk averse to losing any principal. And so the subordinate capital is there to really protect that loss of capital risk to the banks and other institutions. So it's sized to absorb any small business loans that we believed would be lost, would not be repaid. And we used historical data to pencil that out and build up that size of subordinate capital. And one last thought, these are funds that, as I said at the top, we are engaged with today and we will be engaged with in the future. And why? Well, right now we're in phase 2, as this graph shows, and we have funds set up in 18 states. Some of them we've done multiple funds, so we're working on setting up the second fund in California, in New York. And our goal, though, is to get us to a sustainable solution. And that's the big circle, semicircle you see on the right, that we know the demand, because we've penciled it out, is greater than 1 billion, which is about the capital that we're moving today with the recovery funds we have in place, but closer to 15. That's the unmet small business need in the United States. And so how do we reach that? How do we get to systemic solution? And what we see is an opportunity to leverage federal money in the near term. And we're hoping that we can do that, issue a bond and raise private capital off of the federal government subordination or risk capital beneath, and have capital set up to not only scale, but also reliably, sustainably be in place for years to come. And so that's my last thought, just having been in the market for years and doing these transactions. Blended finance is a bridge. It is a bridge to somewhere. There is not enough catalytic capital to do all the blended finance transactions we like to do, and you need it to demonstrate, to bring in that private capital. And so after that first fund, after that first transaction, then what? How do you use that transaction to demonstrate that the perceived and the real risk isn't as great as one might think? Or bring that into a structure that leverages other resources in a way that gets you to that scale and a systemic outcome. And so, Gayle, with that, I'm just going to pause and stop sharing and put it back to you.
That sounds great. And I want to, we've got, please feel free to submit your questions and have a conversation. So we've got one question, Swati, from, you'd like some examples of blended finance for supply chain. Colleagues?
Sure, I can jump in. They exist. If you go back to the comment I made that a lot of blended finance is in the financial institutions sector, some of those financial institutions are in fact doing trade finance or agricultural finance. And so it's obscured, but it is happening. One transaction I can think of that is in the supply chain very specifically. This was a transaction that we helped to get to market with a grant for the team working on it, which was Clar Mondial. Clar Mondial had the observation that a lot of fairly sizable agricultural companies were continuously providing credit to their supply chain, to their suppliers. And they're not banks, but there they are, providing working capital loans year after year to these folks. So the idea was to use them as the first loss capital in a transaction where you bring institutional money in on top of them that otherwise would not take that risk. And you have a number of large corporates so that it's not somebody funding just, Nestle or just Danone or somebody. So that fund structure has been launched and is out there raising money right now. So that's an example of somebody thinking through what risks were already being taken and how you could use that money to leverage additional money on top of it to boost a supply chain by really finding ways to enhance the amount of money that's going to the little guys in this equation. That's one example. There are others out there.
Well, and thanks, Joan. I think that, we do have another case illustration of the working of Humanity United's Working Capital Fund. Again, that's a partnership to address slavery in the supply chain and using technology to do that. So there's very concrete illustrations. And again, the Working Capital Fund, we did a case study on when they were launching and how you build those partnerships. It is now spun off from Humanity United. It is a separate fund. outside of the boundaries of the foundation. But those are the kinds of nuts and bolts of how you get started, and building a partnership with Disney, with Apple, with those large institutions that need to find the technology to control slavery in the supply chain. Eleni, it's good to see you. So we've got a couple of other questions. Chandni, thank you. This is one of the most informative and best webinars I've attended so far. I'm extremely grateful for your time and looking forward to applying to the program. Yes, so well done. And Eleni, it's good to see you. Eleni was part of our impact investing course. And we normally have our colleagues ask these questions, but that's not, with a webinar, we're not set up to do that. Elena, your question, we've seen blended finance used in development context. Could they also be applied in emergency context for business continuity in affected regions, natural or man-made disasters? Jen?
So this is Jen. Yeah, I'll step in. It's a great question because it comes up often. We keep having disasters. There's a need for capital to support at a moment in time. And very bluntly, we'll get a lot of calls at those times from faith investors in particular that really want to reach into the community and be there. And what we have found over years is relief, that immediate moment after the event. Finance is just not the right tool. That is generally where grants need to step in, and quickly, just to support people's ability to survive and get out of harm's way, whatever that might be. The next phase, recovery, which is in fact what I showed with this one small business fund that we've been a part of, is where there's great opportunity. And what my experience has been is in times of recovery, that the opportunity for blended finance is potentially twofold. One, to provide a different type of capital than what the market is naturally providing. And so it might need to be extremely patient, and it might need to be extremely tailored to the community. So even with the small business fund I shared, a big part of the effort was not just building the fund, but getting the word out to these small businesses. And so there was a lot of cost around marketing that we did get grant money for. So back to Joan's archetypes, there was grant money that helped surround that vehicle, and really talk to the community so they knew it was there. There was also a lot of iteration to make sure the structure suited what the community needed at that time. And the second point I'll make is it's a moment to do things different. And, shake up the system, so to speak. It's tricky to both recover and do something different, but we've heard this phrase post-COVID, build back better. And I think that's the opportunity we see with a lot of these transactions right now. And that means being creative, not getting stuck in the patterns we've always kind of templated, but really using them for inspiration. So not recreating the wheel, but inspiration to have that really think and do something different.
Yeah, that's fantastic. Joan?
I totally endorse what Jen just said. I'm in violent agreement with her. In the immediate aftermath of an emergency, man-made or natural, I think the literature out there says put cash in people's hands. They know best what they need. Airdropping supplies even can really take the wind out of local merchants who are trying to sell and suddenly are faced with a flood of free alternatives. So cash really matters in those first horrendous moments. Or blended finance is not fast stuff. This is one of the problems. You're trying to get people who never talk to each other to talk to each other and do a deal together that's going to last 10 years. So we have seen it take, your average financial transaction in a developing market probably takes a year or two to get off the rails anyway. And now you're talking about putting unorthodox bedfellows in the same transaction. So it's not fast. What Jen's transaction with the CDFIs showed, by the way, is they're buying existing transactions off the balance sheet and letting the CDFIs go do new deals. If they had said, no, we're going to support you in this new deals you do, it would have been a lot longer to get that deal off the rails. So speed matters. Blended finance is not necessarily great for speed. It's very good in recovery for all the reasons that Jen has already talked about.
Well, and I think that what's really important about social finance and blended finance is it's negotiation, it's building unusual partnerships, and that takes time. And how you, when I think about the development impact bond or the development impact bond around health that UBS did, players came in and out, people leave. How do you build a sustaining relationship? And Jenn, the Seychelles you said took 4 years ultimately. So how do you have that staying power? How do you use capital to keep you at the table and to align your expectations and your values so that you're continuing to move forward with your impact measurements? And that's critically important to component of this program is how to teach negotiation and partnership building. And I think we underestimate the essence of partnership and what that takes. We've got a couple of other comments and questions. Kaiki, do you have examples of where blended finance has been and can be applied with financing revenue generated and non-revenue generating nonprofits? We do have a couple of case studies, by the way, that do just that. But Joan and Jenn?
Yeah, I've seen some examples of this, and I think the interesting piece, I've seen a lot fail too. I guess that's what's running through my head. And so the interesting piece is kind of setting yourself up for success in those situations, because oftentimes the culture of that organization is not one of investment or finance. And so how do you ensure that the leadership of that organization, that the other employees in that organization welcome this opportunity, see it as a benefit, and fully understand it? So it's actually that first piece around culture that I have found over the years is what really enables those types of transactions to succeed or fail. You can figure out the structuring, ironically, and all the rest, but if you don't have the organization at all the right levels behind you, then you have a bigger problem.
I'll just point out that Convergence happens to be a not-for-profit that has a blended finance structure. We receive grants and we have our own revenue line from membership fees and from training and other things. And speaking as the head of it, I would say that it's incredibly important to get a market signal as to whether anything you're doing when you woke up this morning is useful or not. But there's no way that we could be a public resource relying only on membership dues. So there are other examples out there, I think, where you see nature conservation organizations teaming with a fund manager and putting something out that is, it's not a not-for-profit, but it's a joint venture between two parties.
So, sorry, folks. We just had a husband and dogs arrive from being out in the wilderness, and I think that piece we focused on Concerned Worldwide, for example, is one of our cases where they wanted to get involved in blended finance. They're dealing with a crisis situation, a humanitarian crisis, whether it's war or climate disasters. And the interesting thing, as a nonprofit, they had the core elements that are absolutely essential in blended finance: knowing who's on the ground, understanding the partnerships, building those trusted relationships, because in crisis they had to. So those skills that nonprofits bring to our world is absolutely essential. And I think sometimes we forget about how important that is when we're navigating financial deals. We often shift to let's do the deal, as opposed to let's build the people skills necessary to sustain that community that you're building. We've got another comment and colleague from someone who's joining us in Social Finance 2021. How do smart contracts and data science impact social finance and future strategies? What are the current technology and action research needs in the market?
I'll just comment a couple of things I've seen in outcome-based aid, or whatever words you use for performance-based contracts. A lot of the times, the donor who's saying, I will pay for an outcome, needs that outcome to be measurable and reliable, and they need a baseline. And sometimes data science is the right way to assess some of those things. If you're trying to increase the growth of mangroves somewhere, you need to know where they started. Or if you're trying to deal with payments to a huge number of very small, communities of farmers or whatever, having some kind of digital technology can be really useful and reduce costs. There is another interesting example. We just wrote a case study on something called Aceli Africa. And what that was a group of international NGOs, and I think some of them might be for-profit, who were lending to agricultural purposes in the emerging markets. And they decided to all open up all their lending data to each other and figure out what their cost structure was, what was actually a profitable margin on loans, and then go to donors with evidence to show why it was so difficult to lend to a particular segment of the agricultural, the agribusiness community. That was an example of data driving a discussion with donors, and it was a hard data conversation as opposed to we think we need support here. So data can be incredibly useful. I think we're just at the start of figuring out fintech and how blended finance can use fintech and how fintech can use blended finance. But those are some data points for you.
Well, and we will in class talk about technology as a measurement tool. So we do a deep dive into that. I think that the piece for me is how you pull all these research, technology, people skills, understanding catalytic capital and risk. It is absolutely essential, and it's a messy mix. The interesting thing that I'm seeing out in the world, because of spurred by COVID, is a growing interest in blended capital, and what that really means. I just spoke with about 150 colleagues in Latin America on how do we do blended capital, both philanthropists and impact investors who want to understand what this means. It is the complexity that you just described, really understanding, and I think puzzle pieces or strategists really thinking through how do we build these partnerships? When does catalytic capital come in over the long run? How do we insert it when there's a need? It is magical, transformative, and hard. And that's what this program is really about. And other final thoughts, because we're coming to a close in 2 minutes, and I want to give Layla a chance to say hello. Joan, any other words of wisdom?
Nope, I'll pass to Jen.
It's just been a pleasure to see you again, Joan. We're colleagues and we don't get to see each other. So this was a great benefit of this webinar.
Thanks, Gayle.
It's wonderful for you to come, especially after the long holiday. So
I know.
Layla, I know I was thinking, oh my goodness, let me see if I can quickly do this. And
so thank you, Joan.
And thank you both for joining us. Layla, do you want to say a few words over the remaining minute?
I will be super, super quick. Thank you so much, Gayle, Jen, and Joan. I hope everyone found this helpful and interesting. I mean, I certainly did. And I wanted to echo the sentiments of our speakers today that the social finance program will take a deep dive into social and blended finance frameworks, strategy, language, leadership, and more. You will walk away from the program with a viable toolkit and a network that reaches far and wide. My role is to help put you on the right path to our impact programs. We have 4 that run annually, and I'll link to them in the chat box shortly. So I encourage you to reach out so that we can have a conversation and make sure that we put you into the right program. I would also encourage you to reach out and sign up to our mailing list so that you would receive all the news and updates and future webinars directly into your inbox. So simply email me and I can add you to the list. What I might do is just put that into the chat right now so that you can all have a look, and I'm sure it's up on the screen as well. And once again, thank you to Gayle, Jen, and Joan, to all those that sent through questions, and to those that I've already been in communication with regarding our upcoming social finance program. I am pleased and proud to say that we successfully wrapped up our impact investing program, heading straight into our impact measurement program. And I do hope to see you on our social finance program. I think
Fantastic.
that's everything for me.
Thank you so much. See you soon.